Hello, it's a lovely, lovely morning from here in Delhi, and of course a very cold one and a very freezing one also, because weather down here in Delhi is absolutely chilly and it's quite inclement out over there. But in spite of that, with great warmness, of course, we welcome you. And in this particular session, of course, what we are supposed to pick up, in fact, we have decided today to pick up a very significant topic, of course, IFRS 3, and its Indian counterpart happens to be what we call India's 103. Business combination and corporate restructuring. This is the chapter which we are supposed to actually start. It's a long, I have already told you, it's a pretty formidable chapter, and it's a long one too. You can gauge the intensity of this particular chapter in the sense, the notes which we have provided to you, you must have seen by now. The business combination, it encompasses near about 80 or 81 pages. There are nearly 20 sections which we have created to make this chapter what we call as easily assimilable as it is possible. Although inside of my heart I wish I could say that this happens to be a pretty easy chapter, but unfortunately that is not the case, as we will see later on. There are lots of issues, lots of provisional aspects, and of course it's something very new. And it's absolutely in contrast to the earlier version of business combination and corporate structuring. Mostly you're familiar with the word amalgamation, reconstruction, etc. But as I said, there is nothing of what we call any sort of similarity, and the level of understanding, of course, will be quite high as far as this particular chapter is concerned. So we'll talk about it, but you need not require to worry on that particular count. You can have great trust, and you always had, and I'm really thankful to you for the same. So we on our part, as I keep on saying always, shall leave no stone unturned in making this particular chapter as easily assimilable as easily possible. Correct? So here we go and now have some what we call discussions regarding the what we call this India's 103. But you need to remember one thing. In this particular session, I'm simply trying to actually acclimatize yourself with the terms and the terminology and the jargons of this particular Indians. And once we will acquaint ourselves with all the terms and the terminologies, as I said, then I'm very sure actually later on this particular chapter will become very easy to assimilate and very easy to comprehend. Correct? So the basic idea of this particular session, you need not require to write. In fact, it is going to be a rough work, and later on, as is what we call, I'm habitual to, we will write each and every one. But in this particular session, we are going to simply discuss what actually India says. And we will also discuss what and why, but those questions will pick up after what we call having taken up the initial session. Then in the next one, we'll also talk about why India has provided such guidelines too. But first, what exactly the guidelines are. So in order to acquaint yourself with all the terminologies and the jargons which this particular India has used, basically we are picking up this particular session. So here we go and now actually come to the business end. So as I said a moment ago, the basic idea of this particular session is to acquaint yourself with all the what we call peculiarities of this particular Indias. No doubt about that, this happens to be a formidable part. It forms some what we call part of almost the syllabi of all the professional body all over the world. So even though if you happen to be from outside India, you can definitely actually bank upon these session or these series, because India's 103 and IFRS 3 gamut is absolutely same. Correct? So we start IFRS 3 and its intercounterpart, India's 103, known as business combination and corporate restructuring. As a moment ago, I also told in this particular session, I'm simply going to actually do the rough work. So these are the rough sheets. You need not require to write anything today, because mostly I will use these sheets to write the what we call major work. But here, right at this particular moment, we are simply going to actually have a look. In fact, it is going to be a session wherein you will be given what we call an overview of this particular India. So listen to it very carefully and don't actually skip a single word of the lecture, and be patient, because in order to understand some complicated things, we need to be patient, and I'm very sure you will gain many more insights than it. So here we go and start. Correct? So Remember one thing, this is, you need not require to write at this particular moment. IFRS 3, correct? Or business combination simply. I am writing, actually each one of you are very well aware of this. It is business combination and corporate restructuring. So I am simply writing business combinations. Basically it is a rough work right now at this particular moment. Actually I will keep these sheets here. These are causing a bit of problem. So now it's okay. You need not require to write as I am saying. So just pay attention. In order to understand the concept of business combination, first of all, just have a look down over there. Suppose there is an entity by the name of A and there is another entity by the name of B. Correct? You have already done amalgamation, absorption and reconstruction in your earlier phases of education, isn't it? Now suppose this particular company takes over the control of this particular company. Remember one thing, business combination, Ind AS 103, IFRS 3 I have written, it means it is Ind AS 103. Ind AS 103. In our earlier phases of education, when we used to say that there is a company A Limited and there is another company, say B Limited, and A is taking over the business of B Limited. Generally, in those standards, in earlier versions of standards, correct, we used to call this company as the vendor company. A is taking over the business of B Limited. We used to call it vendor company, or the company who is selling its business, vendor company. And the company which is purchasing the business used to be known as purchasing company. Do you remember in your earlier phases of education, under amalgamation, absorption, reconstruction, you used to use such words? Purchasing company, vendor company, isn't it or not? Vendor company is also known as Vendy company sometime. But anyway, this is the purchasing company, this is the vendor company. A is taking over the business. Remember one thing, whenever during the entire length and breadth of this particular session, or for that instance, all the sessions which we are going to take in the context of Ind AS 103, whenever I would say A is taking over the business, it would also means that I am acquiring the control of this particular business, because later on we would see that Ind AS 103 basically stresses upon the control. Is it clear to you? We will also discuss all those aspects, but later on. I'm trying to keep the things in very simplified, because sometimes it becomes very difficult to be simple. But once simplified things are assimilated, then ultimately the complicated version of this particular Ind AS will become a little bit lighter for you to understand. So in earlier version of standards, whenever a particular company used to take over the business of the other company, we used to use such words, purchasing company, vendor company, etc. Correct? Now the first thing which this particular Ind AS has done, that is, now this company will be known as, in fact, the company which is taking over the business will be known as acquirer company. It will be known as acquirer company. You need not require to write at this moment. I have already told you. These are rough work, correct? That is why I am using these sheets. So acquirer company, acquirer company, to take hold of something. So this word is framed generally out of what we call this particular context, because we are taking hold of now B Limited. So we are the acquirer company, and the company B will be known as acquiring company. Company B will be known as acquiring company. So nothing new. So these are the words which the Ind AS will use instead of the ones which we used to do, or instead of those which we are familiar with earlier. So this you will have to keep in your mind, number one. Second very important aspect, as we will see later on also, I have already told you, we have created 20 or near about 21 sections to complete and comprehensively complete this particular chapter. We have created nearly 21 sections. And we will see later on that in one section we have discussed word business itself. Because this word business, it's very, very important in understanding the connotations of this particular what we call standard. A is taking over the business of B Limited, correct? It means A is taking over the entire control of B Limited. But it is very important whether in this particular transaction Ind AS 103 will apply or not, IFRS 3 will apply or not. That is very important to understand. Why I am saying so? Because later on we will see standard stresses upon one important aspect. The company which you are taking hold of, or the acquiring company, correct? This is the acquiring company, this is the acquiring company. So if we are taking over the control of the business of another entity, it is very important that other entity or the acquiring entity must be a business. It must be a business. This is the word Ind AS use and used frequently. Business. Entity B must be a business. Unless and until the other entity or the acquiring entity won't be a business or won't meet the what we call criteria of business which have been set out by this particular Ind AS 103, we simply cannot what we call apply Ind AS 103. Ind AS 103 will come into picture only when a particular entity acquires the control of other entity or entities, one entity or more than one entities. Correct? But to keep the thing simple, we will simply talk about one entity. So, Ind AS 103 will come into play only if there is an entity which is taking over the other entity, and the other entity or the acquiring entity must actually meet the definition of business which have been set out in this particular standard. So it is very important. First of all, we are not trying to actually find out what exactly the business right at this particular moment. I have already told you, we have created a separate section wherein we have nearly given 8 or 9 case study. Correct? There we will actually discuss what exactly the business is. But right now at this particular moment, I am simply trying to tell you what this particular standard actually settles out and what guidelines it provides. So very important to understand, whenever, of course, business combination, correct, name itself is suggesting two companies are merging or one company is taking over the other company or other entities. But just this particular fact should not actually ignite a feeling in us that Ind AS 103 will come into play. It is very important that acquiring company must meet the definition of business. We will later on actually also discuss what this particular wordings mean. Right now, at this particular moment, just to satisfy your curiosity, I know that some of you are very curious to know what exactly the business is. We will see later on, Ind AS says, or Ind AS states, that business basically means the entity, the acquiring entity, must have some inputs and must have some processes. Must have some inputs and must have some processes. We will also discuss and see later on at great length, no doubt about that. Inputs basically means assets, group of assets. That means the acquiring entity must have some group of assets, and processes basically means set of activities. In simplified version, I am trying to explain the wordings. Set of activities. Set of activities. Are getting my point or not? So the acquiring entity must have some input and processes. Put it in simple words, it means the other entity must have some assets and a set of activities which we can integrate or which can be integrated, can be combined, can be synchronized, and can be managed. These are the wordings given by standard. Can be managed, and managed in such a way that we can derive some economic benefits. That is exactly the business is. Economic benefits. For instance, suppose I happen to be an acquirer and I take the business of some other entity. And other entity is having the assets, but there are no set of activities, so there are no processes over there. So even though I am taking over the business of the other entity, I might not be in a position to conduct the what we call business of that particular entity or manage the business of that particular entity. And as such, I may not be in a position to derive any economic benefits. So in that case, such acquisition cannot be what we call called as a case of business acquisition, business combination. It is very important in order to constitute the business combination. The acquirer entity, when takes over the other entity, then the acquiring entity must meet the definition of the business. As I just told a moment ago, this particular point we will discuss later on also. Right now at this particular moment, intention is to just acquaint you with the what we call all the, you can say, technicalities and the peculiarities of this particular standard. Correct? So business we will see later on. Of course, at length, in simple words, meant it must have a group of assets, correct? And it must have a set of activities which can be integrated, and output can be produced, and some economic benefits can be derived. So whenever I would say henceforth that a particular entity is taking over the other entity, you automatically actually infer that other entity is a business. It meets the definition of the business, because every time I cannot say that way. So first thing first is that you should get yourself acquainted with these terms, acquirer and acquiree. And you need to have a bit of idea regarding business. First of all, you need to understand this. That means if a particular entity takes over the control of the other entity or other entities, then of course business, this particular Indias will come into play, but only provided the acquiring company meets the what we call definition of business. That means this whole process or this whole transaction or event, whatever you may like to call it, must meet the definition of business combination. That is very important point. This is the sole crux of this particular standard. Once you have acquainted yourself with the basic, what we call fabric of this particular standard, these are rough sheets, you need not require to write anything at this particular moment. We are simply discussing the things, correct? Now, next thing, of course, we need to know the objective, correct? We will now stress this particular chart a bit further now. What is the objective? In order to understand the objective of this particular standard, we will see that this particular standard, as far as objective is concerned, is going to establish some principles and of course the requirements. It is going to give us, as I said, some principles and some requirement. It is going to settle out some what we call principles and requirement which the acquirer company need to follow when it will do the accounting. Remember one thing, India's 103 basically stresses the perspective of the acquirer. 99% this particular standard deals with acquirer, you can say in nutshell. Is it clear to you? That is why time and again, and so often you will see during the lecture, most of the time I would call upon what we call acquirer, but at the same time, we are not going to skip, even though many modules of professional bodies are skipping the treatment in the what we call books of acquiry. We will take that too. Don't worry about that. But what problem is that, as I say, major chunk of this particular standard actually talks the perspective of acquirer. So the first thing is that this particular standard, as I said, it establishes some principles. You need not require to write at this particular moment. We are going to pick up all these things later on. It establishes some principles and also some requirements. It means the standard. A standard actually settles out some principles and the requirements. Of course, it means if you happen to be an acquirer company, then you need to follow those what we call principles and requirement. The standard states that these are the objective, in fact, also. The basic objective of this standard is that it settles out some principles and requirements regarding what? Regarding, as I said, recognition. You need not require to write at this particular moment. Regarding recognition, these are rough work and measurement. The standard settles out some principles and requirements with respect to recognition and measurement of what? Measurement of, suppose if I happen to be an acquirer, and if I happen to acquire the business, as I said, whenever I would say acquire, it means I'm acquiring not only the business but the control over that particular business too. So you use the word control automatically or infer it automatically by yourself, correct? So in this chart, which I just drew a moment ago, A is the acquirer, B is the acquiring company. Now, keeping into account the guidelines of this particular India's 103, acquirer A, what it will do is, as per the guideline of the standard, the acquirer A Limited in this particular case must recognize what? It must recognize in its financial statement, in the financial statements, the acquirer must recognize in the financial statement what? Identifiable asset. You need not require to write at this moment. That is why I am using the short form, identifiable asset. I have seen many students actually, they haven't been able to grasp the meaning of recognition. Standard says that acquirer will actually recognize the identifiable asset. Now, what is the meaning of this recognition? Let us say one day my wife actually asked me to bring bananas. And generally, I'm sort of person who hardly actually is interested in buying anything, any grocery item actually, as far as households are concerned, for the house is concerned. Anyway, because it was a dictate, should I say, because ultimately wife happens to be the commander. So ultimately the dictate she gave, I couldn't have declined. So I went to the grocery shop and asked for the person, actually please deliver me 12 bananas, a dozen. I bring the banana. When I bought the banana and put it in front of my wife immediately got red-faced. Oh my God, what sort of things actually you have bought? See, out of these 12 bananas which you have bought, these 4 are in absolutely mutilated condition. Who will eat this? And she scolded me too. Anyway, point here is that in a rage or in a fit of anger, she virtually threw 4 bananas, and by the grace of God, and she showed some mercy upon me and kept the 8 bananas, and she declined to actually accept these 4 because those, in her opinion, were absolutely, as I said, not fit for what we call eating. Now the problem here is that these 8 bananas have been kept, 4 have been rejected. Indirectly it means, now if I am going to draw the parallels, then I would say from the accounting perspective that we have out of 12 recognized only 8 bananas and we didn't recognize 4 bananas at all. Unless and until we would recognize something, we cannot measure it. We cannot measure it. The measurement will always follow recognition. But first thing is that we need to recognize the thing. So whenever we acquire the business of a particular entity, standard actually says that we need to recognize, we'll talk about measurement later on. Remember one thing, we need to recognize the assets. First of all, as per the standard guidelines, that means which are the assets of the acquiring company are there which can be recognized by us. You got the meaning of recognize now? I hope so. So standard states that first of all, you need to recognize all the identifiable asset, and the assets which you have recognized can be identified very easily, separately, of course, it means. Besides, the standard also says that identifiable assets and liabilities. The standard states that when you acquire the business, you need to first of all recognize, I hope you got the meaning of recognition, assets and liabilities. How you are going to recognize, that's a different part. We are going to actually talk about it later on. Right at this particular moment, I am simply mentioning out before you the guidelines of the Ind AS. Correct? Second is, standard also says that we need to recognize non-controlling interest. What is this non-controlling interest? You are very well familiar with this word, non-controlling interest. Do you remember you used to do a chapter by the name of holding companies, isn't it or not? Holding companies, so often you have done as per your earlier what we call version of standards. Now holding company or consolidated account is covered by Ind AS 110 or IFRS 10. We will see that later on, but the point here is that we have used this particular word non-controlling interest under consolidation so many times. Non-controlling interest means, suppose I told in the beginning, we acquire the control of this business. Let us say total share capital of B Limited is 1,000. How can we acquire this entity? Let us say out of total number of shares which have been issued by B Limited, let us say 1,000, I bought 800 shares. I means A Limited. So it means 80% control is now in our hands, and 80% shares are now in our hands. That will deliver us the control. So more or less this particular company has now been acquired by us, because this particular entity will stay in our control. We have a bulk of what we call majority stake in this particular company, 80%. In fact, just to make the point a little bit clear, if we have more than 50% stakes, quite obviously it means we are having the control. But remember one thing, this is not the only yardsticks to determine the control, but we will use it most of the time to actually make the things a little bit clearer, correct? So if I acquire more than 50%, generally control passes to us. So now this entity is more or like in our control. But 20% stakes are not in our control. This 20% is known as non-controlling interest holder. Non-controlling interest holder because they are interest holders in B Limited, but they do not have any control. That is why the name non-controlling interest, correct? So standard states that, first of all, from the perspective of the acquirer, whenever acquirer will take the what we call control of the acquiring entity, it must in its financial statement recognize right at this particular moment, I am not talking about measurement, it will recognize what we call all the identifiable assets and liabilities besides non-controlling interest, and it will also recognize and measure any goodwill. If you remember, in your earlier version of amalgamation, absorption and reconstruction, especially in the books of the purchasing company, when you used to pass the entry, correct, all asset taken over to liabilities taken over, the difference used to be either debited towards goodwill or what we call gain towards capital reserve. That means whenever purchasing entity would acquire the business of other entity, there used to be what we call either goodwill or capital reserve. Similar is the situation here. As per Ind AS, because we are acquiring the business, so quite obviously there might be some loss. We know that goodwill is a capital loss for the purchasing entity because we have to pay extra. So we will recognize goodwill in case if there is any. Besides, instead of using the word capital reserve, now we will use the word gain on bargain purchase. Gain on bargain purchase. Gain on bargain purchase. We will use this word quite often. Now this is a new term which has been coined by this particular standard, gain on bargain purchase. Instead of capital reserve, it is known as gain on bargain purchase. And it's a pretty long word, so I will use the short version that is abbreviated from GOBP, correct? Gain on bargain purchase. First point should be absolutely clear. The basic objective of this standard is, first of all, you must not let it skip out of your memory, which I had told you in the beginning itself, that this particular standard stresses the viewpoint of what we call acquirer rather than the acquiree. So whenever in a business transaction or business acquisition or business combination, acquirer will acquire the business, then acquirer first of all will recognize all the identifiable assets and liabilities, that which are the assets which we need to recognize. In case if there happen to be any non-controlling interest, we will also recognize the non-controlling interest. Besides, if there is any goodwill or gain on bargain purchase, we need to recognize the same. These are the basic objective of this particular standard. Is it clear to you or not? Second point, standard states that is information to be disclosed. Information to be disclosed. When we will have a look over the disclosure aspect, we will talk about this particular at length. That means when we are taking over the business of a particular entity in our financial statement, we need to actually apply the analysis that what sort of information is quite vital for the different parties to understand the functioning of the entire organization. So what exactly is the information which we need to disclose, correct? So there could be some vital informations, there could be some information which may not be quite material. So material information need to be disclosed. So what would be those information? That depends upon the what we call judgment of the management. Is it clear to you? This particular point, we will talk about it later, but the important point is that what standard says, I am simply talking about that. I am trying to acquaint you with all the terminology, jargons of this particular standard, besides the technicalities of this particular standard. Correct? The first point is that whenever you are going to actually acquire the business, you are going to recognize all assets, liabilities, of course. Besides that, if there happens to be any non-controlling interest, you are going to recognize the same. And further, if there is any goodwill or gain on bargain purchase. Now, to be very honest with you, gain on bargain purchase technically is never ever possible. Suppose if I happen to take your business and your business is worth rupees 10 lakh, let us say, the net asset value of your business is 10 lakh. Whenever we call worth, what does it mean? Asset less liability. So suppose the total worth of your business happens to be 10 lakh. Would you sell your business to me at a price which is lesser than 10 lakh? Never. So logically speaking, purchasing company can never ever have what we call gain on bargain purchase. It will 99.99% shall have loss, that is goodwill. Goodwill is a capital loss. In spite of that, why this particular Ind AS uses the term gain on bargain purchase? Because in rare circumstances, it could be a possibility. For example, let us say there is an entity in UK. And as we know, election has just taken place in UK. Now let us say, and nowadays, every nation is simply giving their nation the first priority. And let us say tomorrow, United Kingdom decides that all the businesses of other country should not stay in their what we call country. Let us say there is an Indian company which is what we call operating in UK. Now because of this legislation, let us say legislation enacted tomorrow, that you will have to wrap up your business from UK soil within next 2 years. Now that business is under a constraint, under some pressure, under a legal foundation to wrap up their business, to fold up their business, to wind up their business. So because there is a legal compulsion upon that particular business house, in such situation there is a possibility that purchasing company may have some gain, that is gain on bargain purchase. Logically, gain on bargain purchase is never ever possible, but it is possible only when the selling entity or acquiring entity, as we call it nowadays, correct, is under some pressure. Second point which this particular Ind AS stresses upon, it tells the acquired company that you need to find out which is the vital what we call content of this entire transaction, which is quite important from the perspective of the investors or the parties having interest in your what we call organization. Try to disclose that. Third point, C I will call it. Ind AS, and just a moment ago when I was drawing that particular chart, I did talk about this particular point which I'm writing right now. You must understand that Ind AS 103 or IFRS 3 shall apply only to such transaction or event which meets the definition of business combination. I just told a moment what is business combination. I told a moment that business combination is possible only when acquirer, correct, takes over the business, that is acquiring company. Let us say this is A1, this is A2. This is acquirer, this is acquiring. This will meet the definition of business combination only when A2 will meet the definition of business. This is the important point. Ind AS 3 will apply only when a particular entity takes hold of or control of other entity or other entities, and those entities, or in simple words, acquiring entities, meets the or satisfies the criteria as laid out in this particular standard with respect to term business. I told you a moment ago what exactly the business. That means this business must have some inputs, must have some processes which can be integrated, and output can be produced, and some economic benefits can be derived. Correct? We will talk about all these facets later on. Right now we are simply trying to tell what this particular Ind AS is telling. So these are the things Ind AS is telling in the initial stages. Besides, this particular Ind AS has given us some definitions further. As far as definition is concerned, one definition we have already talked about. Ind AS actually provides us definition regarding acquirer. I have already told you which entity is acquirer company and what we mean by acquirer. Similarly, then Ind AS states acquiree. We know which entity is acquiree, that is the entity whose business or upon whom control is being established. Acquirer is the company who is acquiring the control of the other entity, correct? Besides that, under the term definition, this particular standard uses a word acquisition date. You have been familiar with this particular word, acquisition date. What we mean by acquisition date? It is simple. Suppose this is the accounting year 1/4/2020 and this is 31/3/2021. And on this date, let us say A1 acquires A2. So this particular date will become the date of acquisition. Let us say this date happens to be 31/12/2020. So this particular date, acquisition date in simple words means the date on which the control has been acquired. Besides that, standard gives the definition of business, and I have already explained that. Business. I told you when I drew the chart earlier that business, acquiree must constitute the business. First of all, what business is? Business means there must be some inputs. I told you what is input. Input means group of asset. There must be some input. There must be some processes. Processes means set of activities. Inputs and processes or group of assets and set of activities can be integrated, can be combined. Can be integrated. Correct? Suppose there is a particular company and that company manufactures liquor. It has got machines, it has got manpowers. So machine is input and process is manpower. Of course, this machine and manpower can be integrated to produce the output. Output is liquor. Indirectly, when we say we can produce output, indirectly it means we can derive some economic benefits. Economic benefits could be in any form, in lower cost, in higher profits, or dividend, or interest, whatever it might be. So in simple words, standard states that acquiring company must meet the definition of business. Besides that, we will see that standard talks about business combination. I have already told you just a moment ago the business combination. In fact, these are the definitions which have been given by what we call this particular standard. Business combination we have already talked about. Business combination means such transactions or events in which one entity acquires control over the other entity or entities, and those entities over whom the control is being acquired are meeting the definition of the business. Are you getting my point? That is business combination. You need not require to write at this particular moment. For God's sake, don't write. I am going to write each and every word later on. Don't worry about that. Correct? Then point number E. Under E, this particular standard talks about a concept known as contingent consideration. Contingent consideration. What is this? These are rough work, not fair work. So for God's sake, don't write at this particular moment. Simply pay attention. Contingent consideration. Suppose today A1 is taking over A2. This is sufficient. I need not require to tell you that A1 is acquiring control over A2. I've already told you to use the word control by yourself whenever I would say a particular entity is taking over the other entity. Second inference which you need to draw is, one, we are acquiring the control, and second, it is a business. Then only this particular Ind AS can apply. Now A1, let us say acquiring the control of A2 or the business of A2. Is it clear to you? Obviously, when we are going to acquire any particular entity, we need to pay some amount that is known as consideration. This is known as consideration. Quite obviously. We cannot acquire any other entity free of cost. Honestly speaking, even that is a possibility, but that I will talk about later on, correct? But generally, we cannot acquire any entity without any payment. The payment which we are going to pay to A2 Limited, that is acquiring company, will be termed as consideration. Later on, in fact, this particular standard has given some inputs regarding consideration also. We will see that whatever consideration the acquirer will pay will be measured at fair value, and the consideration can be paid in any manner and in any form, that is by way of cash, by way of shares, by way of equity or preference share, options, share warrants, and even you can give your own business. That is also a possibility. In order to acquire another entity, we may give, let us say, one division of ours to other entity. So you can pay consideration in any form and in any manner. That's a different matter. Right now what I am stressing is A1 acquired A2, and A1 will pay the consideration. And let us say, when it acquired A2, consideration was settled at 50 lakh. We will pay you rupees 50 lakh. But sometime in practical life, what happens? Let us see. A1 tells A2 that today we will acquire your control on this particular date, let us say, and we will pay you 50 lakh. It is decided. Let us say there is another agreement. We will pay you 20 lakhs more. We will pay you 20 lakhs more, provided your entity makes a profit of 30% in next 2 years. That means we will pay you 20 lakhs more in the next 2 years. We will not pay today. We will pay you in the next 2 years, provided your entity will make a profit of 30%. Whenever I would say your entity, many student gets actually bamboozled. I have seen they start blinking their eyes. Remember one thing, whenever I would say we acquired A2, that doesn't mean that the existence of A2 has closed down. Don't be under such a phobia, which I have seen actually many students are under a phobia. We are simply acquiring the control. This business is still functioning. Only thing is that it is functioning under our guidance, under our what we call dictates, under our terms. When I say that we are acquiring this particular entity, many students think actually the existence of A2 is no more. No, that is not the case. So for God's sake, please don't be under that sort of confusion. A2 will keep on functioning and operating. Only thing is that the board of directors will be ours. We will be in the driver's seat. We will give the direction. We will control their financial and operational activities. So we put another condition that will pay you 20 lakhs more. Now this is contingent consideration. The contingent consideration means a consideration which is dependent upon some future actions or future conditions, should I say. So any consideration which depends upon some specific or implied future conditions is known as contingent consideration. Contingent itself means something which depends, correct? So we will see whether contingent consideration is recognized or not. Even standard actually provides us some clues regarding that also. Generally, even the contingent consideration will be recognized, correct? We will see later on also. But right now, at this particular moment, we are simply trying to put before you a bird's eye view of the entire standard. Then further, the standard states, what the standard states then? Further, the standard states that once it has been decided that this transaction is a business combination, A1 is taking over the business of A2, it means A2 is a business, so we may say this transaction is a business combination. So once the transaction or event is a business combination, obviously now acquirer will have to take care of Ind AS 103. It will have to take into account all the guidelines. Some of those you have already seen. Now the accounting part will unfold. As I said a moment ago, we will have to now recognize the assets, correct? Besides that, are there any non-controlling interest holders or not? What sort of goodwill or gain on bargain purchase we have? We will recognize all these. So once it has been settled that this transaction is a business combination, then the accounting part will come into play. Accounting part will come into play. Accounting part will come into play only once it has been decided that this transaction is a business combination. Then accounting will come into play. Under the accounting part, what we are supposed to? what we are supposed to actually state. As far as accounting is concerned, this Ind AS, you need not require to write anything at this particular moment. This Ind AS, IFRS 3 or Ind AS 103, simply states that acquisition method will be adopted. Good thing is that there is no other method. Acquisition method. Acquirer company will use acquisition method to do the accounting. We will see what exactly the acquisition method is now. Acquisition method. As far as acquisition method is concerned, under the acquisition method we will see a first step. Now we are moving over to the accounting part. I want to do the accounting. Transaction is that A1 has taken over the control of A2. Number one, A2 is a business. It meets the definition of business, and this transaction is a business combination. Now acquirer will have to apply Ind AS 3 to do the accounting. In order to do the accounting, what will be your first step? See here, please pay attention. Suppose A1 takes over A2. If I will ask you who is the acquirer, you might be feeling so many times you have told us these things, why you are harping upon the same string. You got the meaning of this phrase? It means why you are repeating this, harping upon the same string. String, you know, some instruments, they have got what we call strings. That means why you are keep on what we call giving us the same tune. Anyway, acquirer and acquiree. I will not ask. A1 is the acquirer, it is A2. But these terms, acquirer and acquiree, that is legally, A1 is acquirer and A2 is a legal acquiree. He is a legal acquirer, he is a legal acquiree. Suppose if I say A1 has taken over the control of A2, obviously we will say in the eyes of the law, A1 is acquirer, A2 is acquiree. But here the complications come. From the accounting perspective, who happens to be acquirer, we will have to see that also. That is the point. This particular standard states that under the acquisition accounting, your first step is identify the acquirer. Who is the acquirer? When standard states that identify the acquirer, it means standard states that who is the accounting acquirer. Because in rare circumstances, it could be a possibility that accounting acquirer may not be legal acquirer. Accounting acquirer may not be legal acquirer. 99%, your legal acquirer will also remain accounting acquirer. No doubt about that. 99%, your legal acquirer will remain the accounting acquirer. But there are some questions, and we have kept a separate section for that. Over that we have given some case study where we will discuss that what are those rare circumstances when accounting acquirer can be different. For example, there could be a possible case when acquiree will have to do the accounting from the perspective of acquirer. What I mean to say is that suppose A1 is taking over the business of A2. Quite obviously, they are acquirer and acquiree. Whenever we say they are acquirer or acquiree, it means in terms of legality. That is from the perspective of the law, A1 is legal acquirer, it is the acquiree. But from accounting point of view, who is the what we call acquirer, we need to dwell upon that also. Now suppose, because most of the time, 99.99% you will be given only this thing that A1 has taken over the business of A2. So under such questions, you need not require to apply or stretch your mind unnecessarily. Under such circumstances, because these are straightforward questions, under such cases, obviously your legal acquirer will be your accounting acquirer also. So you need not require, as far as practical part is concerned, you need not require to apply much of what we call your stretches of what we call thoughts. Only thing is that there are some case study questions when the question will ask you identify the acquirer. So such a possibility may happen. For example, let us say A1 acquires A2. let us say A1 acquires 80% stakes. Logically, it is the legal acquirer. A1 is the legal acquirer and it is the legal acquiree. But let us say there is an agreement that control will remain with us. We will what we call control all the financial and operational activities and we will represent the board. Now if such a control or such agreement is made, although we are having 80% stakes in A2, legally we are acquirer and it is legally acquiree. But let us say there is a contract between these two companies that A2 will take care of all the financial matter and operational matters, and in fact they will also have a say in the representation of the board. So in that case, from the accounting point of view, it will be accounting acquirer. So such what we call rare possibility may unfold, but you need not require to develop any hunches regarding the what we call level of difficulty of this chapter. Don't worry a single bit. In practical sort of question, as I said a moment ago, you need not require to stretch your mind or pain your mind unnecessarily because you will be given limited information. Such things need to be done only when there are case study questions, and we will discuss those questions. We have kept a separate what we call section for the same acquisition method. Don't worry about that. So this is the first step. In order to do the accounting, acquirer will use acquisition method. Under acquisition method, just a moment ago I said first thing is that you need to find out who is the accounting acquirer. Once you have determined that, let us say A is also the accounting acquirer, because most of the time, I told you already, legal acquirer shall remain what we call accounting acquirer. Now, let us say, now coming to the second step under acquisition. Second step is determine the acquisition date. We have already told you. Determination of acquisition date. Determination of acquisition date, that is what we call next step. Let us say this is the accounting year 1/4/2020 and 31/3/2021. Let us say A1 is interested in taking over the business of A2. A1 is interested in acquiring A2 or taking hold of A2 or controlling A2. So A1, the shareholders or the management of A1 and A2, let us say meet here on this date. They have a meeting and they have a discussion. Let us say whatever, in the month of, let us say May, they meet. In the month of June, let us say an agreement was signed between the shareholders of A1 Limited and shareholders of A2 Limited. Here the agreement has been signed. Okay, we are ready. And let us say on 1st July, A Limited issues the consideration. Shares were allotted to A2. So this date will be considered as the date of acquisition. The date on which in real terms we have acquired the control. Is it clear to you? Because once I told you we have paid the consideration and got the shares. Correct? Sorry, on this date we paid the consideration and got the shares. So naturally now we have the major voting rights and we are in the driver's seat. So this will be considered as date of control. Again, we have kept a separate section and we have given some case study also. Some case study question may be asked like this one, but not very difficult, this particular point. So this was your second point as far as accounting aspect is concerned. Now we come to the third point. Under acquisition method, first of all, we need to find out who happens to be the accounting acquirer. Then we need to find out what exactly is the date of control, because ultimately we have to record or do the accounting on that particular date. That is the significance of what we call date of acquisition. Now, under point number C, standard says that we have to recognize and measure. We have to recognize and measure what? All assets which we have taken over, all liabilities which we have taken over, besides non-controlling interest, and we will have to compute goodwill or gain on bargain purchase. This is the third step, which we talked earlier also. Standard says that In order to do the accounting, obviously, when I'm taking over the business of some other entity, I will acquire some assets and assume some liabilities. So which are the assets which I have taken over? Which are the liabilities I have taken over? I will recognize them and I will measure them. How I will measure them, I will let you know also. All assets and liabilities which I have assumed, I will definitely recognize them in my books now, in my financials. Besides, if there are any non-controlling interest, I will recognize the amount of non-controlling interest. And if there happens to be any goodwill or gain on bargain purchase, I will also recognize them. But before we dwell further, try to understand. I'm stopping here right at this particular moment. We'll talk about this particular step in the upcoming session.